the CLS Market Review for the week of July 22nd, 2013. I'm Matt Harwell. Markets were relieved this week as Fed Chairman Ben Bernanke spoke to Congress on Thursday, claiming it was too early to determine if the Fed can and will start to taper their support of the economy through Treasury and mortgage-backed securities purchases. Any sign the Fed has given the public that it may withdraw its aid has tended to make market participants become spooked. Equity markets closed mostly higher this last week as the Dow was up 0.5% and the S&P 500 up just over 0.7%, with the S&P 500 setting a new record high at 1,692. The Nasdaq struggled a bit as big tech names Microsoft and Google reported weaker than expected earnings. So far, second quarter earnings are demonstrating modest earnings growth, with financials leading the way as Morgan Stanley and Citigroup both reported positive earnings surprises. Of the 104 companies that have reported earnings so far for the second quarter, 72% have beaten analysts' expectations. Here now with a special update on housing recovery is CLS's Manager of Investment Research, Paula Week. Paula?
Thanks, Matt. Are you looking to buy a new house? Are you holding off because mortgage rates have climbed almost 1% since May? Are you checking mortgage rates daily and cringing, feeling like you dropped the ball on a great buying opportunity? Here's something to make you feel a little better. Although rates have recently climbed, housing affordability is still near historic highs. Yes, it may not look as good as it did a couple months ago, but when you take a longer-term perspective, I believe that today is still an excellent time to buy that new house. Through the infamous Federal Reserve Program known as QE3, the Fed has been buying $85 billion worth of Treasury bonds and mortgage-backed securities per month in an effort to keep interest rates low and housing affordability high. When Fed Chairman Ben Bernanke spoke in June, he suggested that the central bank may start slowing its bond buying within the next several months, and this has caused investors to begin selling out of their 10-year Treasury positions, driving up both yields and mortgage rates, as mortgage rates are highly correlated with the Treasury market. So how can the housing recovery continue despite higher mortgage rates? It takes a combination of strong housing fundamentals, low inventories, and steady consumer demand. Currently, home inventories are incredibly lean, with less than 5 months of existing home sales. To put this in perspective, more than 10 months worth was available back in 2008, and last year's supply fell to 5.9 months of inventory. An increase in consumer demand and disposable income and a decreased unemployment rate are all additional factors which will likely help support house prices as well. The risk rising rates could have on the housing market are certainly present. If rates rise before income levels can keep pace, home sales could decline and home values will likely stay put until incomes can catch up with rates. Otherwise, home values will have to decline in some markets, such as on the coast. Rising rates could generate a few positive feedback loops, however, as financial institutions loosen their tight credit standards. As house prices rise, default risk on mortgages tends to decline. Couple this with higher rates that banks can earn on loans, and they will suddenly be much more willing to lend to consumers. In addition, collateral of the loan, the house, has substantially improved as well as their profitability on the loan. In my opinion, housing still remains a bright spot in the economy, as the sector should still grow at a decent pace in the long term. In addition, with house prices increasing year over year at 12%, consumers will likely continue to feel good about their household balance sheets for a while, supporting consumer demand, which is then supportive of the economy and the equity markets. The consumer should still feel good about buying a new house, as mortgage rates are still below the 13-year average.
Thank you, Paula. As a reminder, our market review for the second quarter of 2013 is available now at clsinvest.com. It's a little longer than our weekly reviews, so go ahead, make yourself at home. That concludes our update for this, the third week of July. Have a great week.